Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market update. So in today's markets, guys, not much macro headlines, nothing negative to derail the markets. So everything just kind of grinding its way higher. SPY up 0.04%, QQQ up 0.19%. And it's very nice to see the continued rotation between QQQ, XLF, and XLV. Always nice to see that when one is up, the other two are taking a break, and vice versa. Last week, when QQ was taking a little bit of a breather, you did have significant gains in financials, maintaining mostly flat here, but healthcare really making up for the most part. So very nice to see continued rotations in the markets, which means that our overall bulls are still healthy, even though, as I showed in yesterday's video, the market breadth is down as a whole, meaning that your top gainers of the S&P 500, your larger components, have been responsible for most of the gains into 2024 so far. The market breadth is thinning, but until the bears actually show signs that they want to control some of your shorter term levels, well, the bulls will just remain in full control. But just keep an eye, guys. We are coming up on that February and March seasonality. You can see here down in terms of your S&P 500 seasonality. In terms of the month of February, usually after the midpoint, we tend to see a drop-off, which does last into most of the month of March before resuming on a nice rally into April and May. Now, this also is in line with our thesis. You have the Federal Reserve reducing rates coming only in the May period, potentially, or maybe even June. So there's really not much positive catalyst to be looking for here in the month, or in the end of February and in the month of March. That'll be post-earnings season, so you won't be able to have any outsized gains provided by your earnings, and it's just going to be a fairly, it's going to be a period of lull in the market. Not much happening, so that is definitely when I do expect us to cool a little bit down after the significant rise November, December, January, and now into early February as well. So just keep that in the back of your mind, guys, as we approach the next 2 weeks of trading. So in today's video, we are going to do a lot of earnings previews here. So we're going to go over your 3 earnings that I've prepared for you guys. One is going to be Uber. Number 2 is going to be ARM, and their significant 48, almost 50% rise today. Ticker symbol ARM, semiconductor play. And then lastly, we're going to take a look at CloudFlare, which reported earnings after the bell today. So here's how we stand on earnings through most of the week already. So we're going to be covering obviously, we're going to be covering ARM, which happened yesterday, CloudFlare, which happened today, and Uber, which happened yesterday as well. Tomorrow, we'll be going over PepsiCo, and then I'll pick a couple more that we didn't have time to do, most likely S&P Global, which you can't see because my head's behind it. So S&P Global down here, and most likely we're either going to cover one of these 3, Affirm, Pinterest, or Expedia. I'll be going through all of those 3 individually and pick the one that I most likely want to show on the channel. So now that we're pretty much almost through earnings season, it'll be notable to see how our company's performing. So we have some research here by FactSet. It is dated on February 2nd, so it doesn't encompass this week. So we'll have to take a look at how this report is going to look on next Monday. But as of last week, guys, everything was looking fairly good. Earnings scorecard for Q4, 46% of companies reporting actual results. So before this week, with this week, it'll probably be closer to 85%. Of those that reported, 72% of S&P 500 companies have reported a positive EPS surprise, and 65% of S&P 500 companies have reported a positive revenue surprise. So for the most part, a majority of companies outperforming on their most recent earnings, which is really contrary to the expectation of S&P 500 companies potentially having revised earning to the downsides in 2024 due to a potential fear of recession. As a matter of fact, guys, S&P 500 EPS is supposed to actually go up 9%. So most of your companies in the S&P 500 will deliver strong results into 2024, meaning that EPS of the total index should be rising by about 9% year over year. That is very good. For earnings growth itself for Q4 2023, the blended earnings growth rate for the S&P 500 is 1.6%. Very decent growth rate for the S&P 500 as a whole. If you take this on an annualized basis, well, 1.6 times 4 pretty much is going to be roughly 6.25%. But the actual expectation is that later on in the year, EPS will actually be going higher because of lower rates. So we're looking at closer to an annualized rate for 2024 of about 9% EPS growth for the S&P 500. So very, very decent so far in terms of your earnings results. And it's made room for a lot of companies to absolutely skyrocket after earnings. You've seen some really outsized gains. There hasn't really been outsized losses as there was in 2022, when every single company, as soon as they would report good or bad, would go down 10, 20, 30% off their earnings. Now we're starting to get a little bit of the opposite, guys, where even companies who are reporting standard in line results are getting significant boosts. And we talked about that earlier when we covered Palantir earlier on the week. And I'll show you another one today in ARM, in the ARM stock, right? So that is another one that they didn't report substantially amazing results, but still benefited from a 50% share increase. So it just goes to show you guys, there's a lot of pent up demand for growth in the market, but there's a lot of money currently still on the sidelines. It does feel as though people are kind of nervous to take bets on some of these stocks until they see the crowd running for them, and then they push them up even more, which has largely been the case in the forms of Palantir. Earlier in the week, we had Facebook do the same thing last week with over a 40% gain. So it just goes to show you guys that there are people still willing to play these markets because there's so much money on the sidelines right now. Just need to wait for a majority of those people to get out of bonds, out of money markets, and back into stocks. But it just goes to show you guys that there can be outsized gains over the course of 2024. If people start participating like they did back in 2020 and 2021, we should start seeing some more outsized gains on a more broader market, not just your Magnificent Seven. So in terms of those earnings, we're going to go over those earnings. We're going to go obviously over our major indexes for the day, and lastly cover our major tech stocks. Now, let's take a look at the heat map, right? So heat map, fairly mixed market as we were saying, right? So big tech, fairly mixed across the day. A couple of performers in semiconductors had a good day, but your major ones, NVIDIA, AMD, kind of tapering down a little bit there. Healthcare was fairly mixed on the day, and financials ever so slightly negative on the day because we did have a little uptick on yield. So financials taking a little bit of a breather though, but for the most part, QQQ was green on the one-day relative performance. You'll see the same, that the market was pretty much mixed across the board. Nothing notable to report here. Healthcare, financials down, technology up in terms of your leader on the week. And on the 1 week relative performance here, you guys can see that your negative components, guys, basically real estate and utilities are your loss leaders. That's just been because yields have been on a significant uptick over the course of the week. So it's very natural that those are the worst performing sectors. Now, before we get into more technicals, let's break down some earnings for you guys. And we're going to start off with a very good one, Uber. Now, Uber is currently sitting at all-time highs. After being absolutely crushed in 2022, they've had a heck of a recovery since the bottom in 2022, right? We're talking about over 250%, right? So a 2.5x if you would have picked the bottoms down here. But Uber is a growth story that has now become profitable. And this was what I was personally waiting for before investing more in the company. Really nice to see, guys. So a couple of the highlights, they have their first year as a fully profitable company, meaning positive EPS and positive net income. That was a problem for Uber for a very long time, but it's very nice to see that now they're finally bringing money to the bottom line. Their total monthly users is nicely up. We're going to go through the statement and show you guys that as well. They have a very high EPS growth rate of 35% a year through 2027. That is extremely good, guys. Revenue growth of 12% through 2027. Very good. Want to see that over 10%. They have a low amount of share compensation, which is something as well we look on the channel to see if a company is a good investment. They're now free cash flow positive as a result of being positive on their bottom line. They're now free cash flow positive as well. And they don't have a high amount of debt. Everything of this company I really, really enjoy, guys. And you can just see if I move myself over down here, how they've had expanding net income, right? Now their past most recent quarter, net margins of 14%. That's a very stark contrast with what they were doing before in prior years when they were even negative or just barely slight positive, about 2-3%. Now a nice net margin of 14%. So looking forward to see them bringing more and more money to the bottom line and returning some of that to the shareholders. Very, very, very decent. Now let's get into the headline here. Uber beats estimates as revenue bookings see double-digit growth. Extremely good to see bookings having double-digit growth, guys. That is one of the largest metrics for this company as a whole. Now, the number of Uber's monthly active platform consumers reached 150 million in its fourth quarter, and it's up 15% year over year from 131 million. That is a ton of active users, guys. 150 million users being using Uber's platform, essentially. That is absolutely amazing. There were 2.6 billion trips completed on the platform during the period, up 24% year over year. Take a look at your mobility. So they have two divisions, obviously. Mobility is just your Uber rides, and then they have deliveries as a whole. So your mobility is up 29% year over year to $19.3 billion in terms of gross bookings, and delivery is $17 billion, up 19% year over year. So gross bookings just mean the price that you pay on the app. Obviously, Uber doesn't collect all of this money as it has to pay its drivers as well, but it's just nice to see that their top line bookings numbers are decently expanding, and they have a very good 2024 in terms of guidance as well. So let's take a look at some of the highlights from their earnings report. So comments from the CEO here: 2023 was an inflection point for Uber, proving that we can continue to generate strong, profitable growth at scale. Our audiences are larger and more engaged than ever, with our platform powering an average of nearly 26 million daily trips last year. It's just crazy to think about that. There's 26 million Uber trips circulating every single day. That is very, very, very good. Now let's take a look at some other financial highlights here. So this is exactly what you want to see. Monthly active platform consumers, which we went over in the article, up to 150 million, 15% change year over year. Number of trips, 24% change year over year. These are very good numbers, guys. Gross bookings up 22%, right? Extremely good. Top line there. The revenue that Uber makes itself from these gross bookings, almost $10 billion in the year in revenue for Uber from these gross bookings. That is netly up from year prior as well, up about 15%. And you can see that they finally have free cash flow, guys. Finally having positive free cash flow for the year, if I'm not mistaken, just over $1 billion. We're going to go over that lower in the statements here, but very nice to see that Uber is finally a profitable company. There was a big discussion whether or not the company could eventually turn a profit, and now they're really showing that they truly can. They've been managing expenses very, very well, all while growing their top line. So here, that was your quarter ended. Now let's take a look at your year ended as well. So here's your net income in terms of your total bottom line profits for the year. Very, very good. $1.9 billion in net income for the year, and over 3.3. It was actually not one, it was about $3.3 billion in free cash flow. That is excessively good, guys, just in terms of their ability now to service the little amount of debt that they do have. So ending 2023, the debt that they had on their balance sheet was about $11.2 billion, $3.36 billion of cash flow generated during the year, and they already had about $5.5 billion of cash and cash equivalents. So now they are largely in a position to easily service their long-term debt, which is going to make them even more of a solid company in terms of your financial ratios. Now let's take a look at your some of the numbers down here below, right? I just want to take a look at your stock-based compensation, one of the last things we look at the channel here. So stock-based compensation as a percentage of revenue is not that high, guys. I actually like this a lot. So let's take a look at your year ended December 31st, 2023 here. So you'll see total stock compensation here was about $1.9 billion here. So if we take 1,935 divided by their total revenue that they do bring in, you'll see that's really not a total large amount from their total revenue that they're taking in. 1,935 divided by your 37,281, right? We're only roughly about 5% of total revenue from in terms of stock-based compensation, which is not that much. It's really comparable with other large tech companies out there, but when we go over the CloudFlare earnings soon, you'll see why this is very important. So this is a respectable number, nothing wrong to say there. So Uber has been really, really good, and their free cash flow, obviously you see the progression here, net progression from negative free cash flow per year, so losing money hand over fist, and now finally becoming positive. So strong balance sheet, strong free cash flows. Their metrics are very decent. Their EPS is growing at 35% year over year. Revenue is expanding ever so slightly here at 12% per year. In terms of their financial ratios, guys, everything is looking very decent. We'll do a few together right now before we end this presentation on Uber right now. So if we take in consideration, let's say their forward earnings for 2024 of about $1.18, right? And then we take their share price. So let's just do some quick math together. So 71.61 divided by the $1.18 of pretty much EPS that we're going to get in 2024. So that represents a price to earnings ratio on a forward basis for 2024 of about 60.6. Now you might think that's high. However, Uber is growing their earnings at 34% per year. So EPS expansion is going to be very, very quick leading into the next 3 years. Look at this, 118, 196, 280, 354. So it represents a growth rate here of 34%. So if we take our price to earnings ratio and we divide that by your growth rate, you'll see that it's a PEG ratio of only 1.78. Now for a growth company that's growing as fast as Uber, that is very, very good, guys. The best PEG ratios that you can have for growth companies per se is about between 1 and 2. Anything over 2 gets a little bit overvalued, even if you are valuing a growth company. So for Uber to be at all-time highs in terms of prices and still be under a 2 PEG ratio just goes to show you that this company does still have some value left into it, even at current prices right now. So if Uber, in my opinion, if Uber was to pull back into the $60 range, I may be tempted to play a lot more short puts and take a position on the company. I do believe the company will consistently deliver very nice results here in the next 2, 3, 4, 5 years if they can keep this profitability going, which really seems as though they can. Now, second company we're going to be going over is ARM. So ARM had earnings yesterday, and take a look at this massive candle that they got all the way up to about 64% before ending the day up about 47%. That is absolutely ridiculous gains, guys, for the day. Obviously, they're in the semiconductor industry and they get the 20% semiconductor premium, as I like to call it. So pretty much, you know, stocks in semiconductors, when they report standard or slightly good earnings, they get a 20% extra rally on top of it just because of the AI hype and the chip hype in terms of that. So a couple notable things about the company. Yes, they're part of the AI and chip hype cycle right now, so they do get a little bit more premium. You know, traders and investors are willing to give more premium to the stock, even though the valuation is fairly rich at that point. Investors just bidding it up in hopes of being able to sell it to somebody for even more down the line, right? But we'll see when we talk about valuation. The valuation is really starting to get that up there at ARM. I didn't even personally like the valuation that much when it was at IPO prices at about $60, you know, $48, $50. You could have made an argument for it, but now at $113, valuation is pretty much out the window if you ask me. But they are part of the hype play. Now they have increased guidance in terms of the earnings that they reported yesterday. So you'll see that they had a double beat on earnings by a substantial margin, 17% beat on EPS and 8% beat on revenue. And they do have 20% EPS growth through 2026. But in my opinion, at the current valuation, that is just not enough EPS growth over the next couple of years to justify the current growth rate here, the current multiples that you have on ARM right now. And the cons, you'll see, I've wrote that down. The valuation is about a 96 forward price to earnings ratio for 2024. Very high, guys. But if you take into consideration their 20% EPS growth rate, you divide your 96 by your 20%, it's a 4.83 peg, right? We were just going over Uber. Anything between 1 and 2 is acceptable. Anything below 1 is truly phenomenal for any company. But between 1 and 2 for a growth company that's growing fast, I will accept. But at 4.83, that is very rich. And number 2 con is they'd have a very big lockup period. So there's only 10% of shares outstanding currently circulating in the market. SoftBank, the people who own ARM, in terms of the majority shareholders, right? They have a very big lockup period expiring in March. So all or a certain percentage of that 90% of shares that are not on the market will be released onto the market. And that is synonymous with dilution. So if you thought that the valuations were bad now, just wait until more shares come onto the market. More shares come onto the market, guys. It'll make this earnings per share go down because there's more shares outstanding, of course. So we're going to take a look at how ARM is delivering right now. So ARM shares surged 48% after SoftBank-controlled chip designers issue strong forecasts. So the forecast was fairly good, guys, but nothing substantial, nothing similar to the increases in NVIDIA. But we're going to go over the numbers and see that they did beat the expectation here. So ARM chip designer said in its ARM's chip design technology is in most smartphones and many PCs. The company reported adjusted earnings of 29 cents, topping the average analyst estimate of 25 cents. So they beat on earnings right here. And they also beat on revenue as well. Revenue rose 14% to 824 million, beating the 761 million average estimate. So a nice beat there on revenue by almost 10%. So you really like to see that beat. Those are two of the reasons, guys, that the stock went up initially on the day. I'm pretty much saying that traders kind of carried it into today, but a majority of the pop in your pre-market and after hours yesterday was due to the inherent beat on earnings. For the current quarter, ARM projected earnings per share of between 28 cents and 32 cents on sales of 850 to 900 million. Analysts were expecting 21 cents per share. So net beat in guidance increase as well. 20% guidance increase, at least between 20 and 30% guidance increase on what was previously out there. And obviously the revenue projection now between 850 and 900 million is about 10-12% over your 780. So not only did they beat their current quarter metrics, but they increased guidance metrics for the next quarter as well by a substantial margin, which is why the company really took off this morning here. Is 40, 50, 60% justified at these current valuations? No. In a parallel universe, guys, if ARM would have reported these earnings, let's say in a market that is pretty much on a downtrend, let's say they would have reported these earnings last October, I don't even think the stock would have been up 6, 7, 8% in the after hours. But now that everybody is extremely bullish, you have a lot of FOMO in the markets, you have a lot of greed right now after such a substantial rally, that is why you're getting these outsized gains. I don't believe the fundamentals justify it, unlike a stock that rose 40% last week in the name of Meta. Even Palantir, guys. Palantir's rise has been a bit overdone, in my opinion. So let's go over exactly what ARM does. So let's go through some of their investor presentation slides and see how the company is doing and check on their valuation metrics. So highlights, $824 million in revenue. Fine, up 14% year over year. Their license and other revenue is up 18% year over year. This represents a very big line of business for ARM. It's licensing that they generate from products that they could have even sold 10, 15, 20 years ago. They are collecting licensing and royalty fees from those. Royalty revenue up 11% year over year. Their other major line of business. So what ARM does essentially is they design schematics for semiconductors. So they are the people who design the layouts for the chips that other people will produce and use. And for those designs, obviously companies have to pay licensing fees and royalty fees while they're using those designs for X number of years that they are using them. So you'll see now that operating income is actually positive. So nice operating income up 17% year over year. ARM has never had a difficulty in generating profit. If I move myself over again, you'll see that over the past couple of years, their net margins have been relatively good, guys. 19, 20% on revenues of $2.53 billion. So profitability has never been an issue for them at all. And they also had trailing 12 months of free cash flow up 63% year over year. So I like to see that $724 million of free cash flow in the quarter. In terms of free cash flow, guys, ARM really doesn't have a free cash flow problem either. It doesn't have a debt problem. So the company, in terms of the balance sheet, is relatively good. You'll see that end of the last quarter. That's not here right now, but take a look here, guys. In terms of debt, only $221 million of debt on the balance sheet. They generate over that in free cash flow per quarter, and they're sitting on about $1.5 billion of cash and cash equivalents. So the company's balance sheet is very solid. Their free cash flow is solid. Nothing to say about that. They're growing EPS well. They're growing revenue well. It's just that the price of the stock is not right. The company is great. The fundamental, business model of the company is great. It's just this is a case where the stock price is not correlating to the underlying business. That's all I'm saying. Now, Q3, from revenues to profit to cash. So take a look here at the royalty and licensing revenue, right? So this is your total revenue. Take a look at their cost of sales, guys. It's absolutely nothing, right? Let's take their cost of sales, right? 27 million. It's about 90. They put it there up top for me, right? So 97% gross product margin. That's absolutely disgusting when your cost of sales is so low. Now, where they lose a lot of their money is in terms of their operating costs and servicing costs. So it does come down from there, but still able to generate from that, guys, about 20% net margins. But that was a highlight that I figured that I'd like to show you guys as well. Now, take a look at their progression curve in terms of revenue. So you'll see that the revenue curve is expanding fairly nicely. So in terms of the next few years, guys, ARM's revenue will be growing at a growth rate of between 10 to about 12%. And you can see that down here. So I've highlighted just you see that, over the next couple of years, roughly about between 15%, let's call it about 15% growth rate. So, very good. But however, when we go into the valuations, we'll see that the company is a little bit overvalued. Their royalty revenue has been coming up as well. They're maintained fairly flat over the past year, but very much up since 2020 or 2021. Now, I do want to go down over a few more things, and then we're pretty much going to wrap it up on this one and go into CloudFlare here. So you'll see that their non-GAAP cost of sales and operating expenses, they've been doing a good job here of trying to keep them as low as possible while increasing revenue. So very, very decent that you can see here, guys, that their cost of goods sold is not actually exploding, and their cost of sales and operating expenses are not exploding while revenue goes up as well, only up about 7% year over year. So when a company is growing revenue between, 15%, let's say for the next 2 years, and their OPEX is only going up about 7%. That's very good. Their revenue growth is outpacing their expense growth as a whole. Now let's go down to a few more slides here. The guidance is the last one I wanted to show you guys, right? So guidance, revenue for Q4 for fiscal year is the one that I wanted to show you. So the revenue they're forecasting is roughly between $3.1, $3.2 billion, which does represent a decent increase from the current quarter. Non-GAAP operating expenses is only supposed to be about $1.7 billion, which is roughly in line with that 7% we were showing earlier here in terms of the growth. And non-GAAP fully diluted earnings per share about between $1 and $1.24 as a whole, right? So if you take that $1.24, right, take the EPS right here. So let's take the 114 is your current share price divided by that $1.24 on the high side of their guidance. That represents a price to earnings 2024 ratio of 91.93. Now, they are growing EPS at about 20% per year, which is why we divide the price to earnings ratio by the growth rate. And you'll see that's how we get a roughly 4.6. I have about 4.83 peg because I took a different ratio down there. But you get the point, guys. It's between 4.5 and 5 in terms of the peg ratio, depending if you take the higher end or the lower end of their expected guidance for the year. Just a bit too high, in my opinion, guys, right? So ARM would be a play that I would be interested in playing, but it really has to come down a ton for me to ever be interested. Again, I'm talking about it have to come down to where it was before earnings, pretty much $75, $70 is where I personally find value in the company here. I know that there's a lot of long-term bulls that might be watching this and saying, well, that's very low. Well, it's just in terms of the financials, guys, right? They haven't yet grown into this valuation yet. They are getting a very juicy premium from the market today, and congratulations to all the bulls. I'm just saying that for me, at this current valuation, it's very tough for me to be buying up here. So that's pretty much everything for ARM. Now, lastly, let's get into your CloudFlare earnings. So CloudFlare also delivering some very decent earnings in the after hours, up 23%, all the way up to about 111 in the after hours. So now CloudFlare really starting to retrace up. They were kept down a significant amount, dropping from their 21 highs all the way to bottoms of about 83%. Now performing well from the bottom to where they are now, about 123% of upside, roughly about a 2.2x, right? So not that bad at all, up about to 111. Upside resistance targets remain put at about 131. But there's one thing about this company that I don't like. And number one, it's the fact that they're not profitable. This is why I prefer Fortinet for a cybersecurity play as opposed to CloudFlare, even though CloudFlare does have a very wide market and very big partnerships with the largest players in the game. They just don't bring any money to the bottom line. Take a look at their last 5 years. No money to the bottom line. And this year has been relatively the same. No money to the bottom line as well. So they have huge partners. The amount of users that use the service is up. They do have a very high EPS growth rate of 40%, revenue growth rate of 24% for the stock. So take a look at this beautiful EPS expansion over the next couple of years and take a look at their revenue expansion is really starting to get that exponential growth curve in terms of the company, which is what you like to see. It does have positive free cash flow now. They have low amounts of total debt. So if we take a look at their financials in terms of their balance sheet, so their balance sheet only about $1.58 billion worth of debt. That's really not that much, guys, when you take all things considered, right? This is the company generating about $1 billion, just over $1 billion in sales for 2023. So to have $1.5 billion in debt is not that much, especially when the company is growing that much. So at least their balance sheet is relatively healthy, guys. But when it comes to the cash flow statement, I have some problems, and it comes from, so they're reducing their net losses. Net losses are coming lower and lower now. On a quarter-over-quarter basis, you see they're doing a good job of trimming these losses, hopefully one day be profitable. But the cons, the expenses keep ramping. They're not able to keep them fixed. So that's what I want to see. Number two, the amount of share compensation for this company is absolutely ridiculous. For a company not making any money, I don't see a reason for the shareholder compensation to be this wide for employees and compensation. You know, it really doesn't do a good job of tying management's performance of profitability into the company when you compensate them so highly and you're still not able to turn a profit, largely because of your shareholder compensation. You'll see, guys, if they didn't have as much shareholder compensation, they'd be bringing money to the bottom line for all shareholders, not just executives and management. And the valuation is relatively high as well. They trade at a roughly a 5 peg. So we're going to get into that as well. So here we go on CloudFlare. CloudFlare stock jumps 21% on earnings beat as the company wins larger deals. Now, CloudFlare's revenue rose about 32%, consistent with growth in the third quarter, according to a statement. The company's net loss of $27.9 million or 8 cents per share narrowed from $46 million in the year ago quarter. So doing a good job of bringing the net losses smaller, but still not profitable. With respect to guidance, CloudFlare called for 13 cents in adjusted net earnings per share on 372 to about 373 million in revenue in the first quarter. Analysts surveyed had expected 12 cents. So even the guidance is not that far up, right? Only about a 1 cent boost in guidance, and adjusted earnings of revenue is largely the same, right? So the guidance came right in line with analysts' expectations. So even though the company beat in terms of on their net results here today, their guidance was flat. They beat on EPS by a wide margin, 24%. Revenue beat by about 2.65%. The guidance for next quarter wasn't tremendous, but still the stock in the after hours going up over 23%. So let's take a look at some of their numbers here across their financials and see what is wrong, in my opinion, with CloudFlare. Despite the fact that they've been up a significant percentage today and had decent guidance and did beat on EPS for the quarter, there is a couple things inherently wrong with the company that needs to be addressed if they want to be able to grow even more. Now, you can see revenue here. Here is your headline number, 32% quarter over quarter on a yearly basis. So that is very nice. But their cost of revenue, guys, has also increased by about 22%. So it really takes away from that revenue growth right here. You'd like to see cost of revenue not be so high when you're increasing revenue this much. Now, here are the kickers. The operating expenses, guys, this is what makes them go negative. Now, their cost of revenue to make that revenue is not so much, but when you come into the expenses that can otherwise somewhat be avoided, this is when my problems with the company start to really give me an itch. Now, sales and marketing expenses on a quarter over quarter basis from 2022, right? Up 25%. That's just not acceptable, guys. Research and development costs, okay, I can give it to them. They're trying to grow the business, so they may need their R&D spend. 21%, not so bad. I've seen worse for companies. But here is the kicker as well. G&A, guys, general and administrative expenses, 31% growth on the Q4 from 2022, from 2023. It's just not acceptable. And when you take it on a yearly basis, it's not much better, guys. These numbers are also largely the same. That is why the company is generating an operating loss, because they just have too many operating expenses that they need to cut back. And the number two thing, guys, that I really don't like about this company is the fact that they do a ton of shareholder compensation. So take a look at your stock-based compensation expense, $274 million. Why? I don't understand. Now, that is up 35% from 2022. We're now sitting at $274 million. So if we take this, guys, let's take a look at your $274 million roughly in stock-based compensation and divide it by their total revenue, similar to exactly what we did for a previous analysis, let's say on Uber, let's say. So 274 divided by your 1296 total revenue, it's 21% of total revenue, guys. And that's before costs, the cost of revenue, and that's even before operating expenses. It is just too high and unjustified, in my opinion. When the company is not yet profitable, guys, you cannot be paying out 21% of gross revenue in stock-based compensation for the year. That's just a slap in the face to shareholders. And that is my big gripe with the company. Now, let's take a look at their metrics right here that I told you guys that I would show you, right? So their valuation is about a 5 peg right now. Now, they are growing EPS at about 40%, but take in line their current price to earnings ratio. So let's just get it right now. So they just reported Q4 end. Let's call it 2024. Let's take their 2024 end of year earnings, right? So only about 54 cents for end of 2024. Now the company is roughly trading at about what? About $110 right now in the after hours. So let's take your 111, right? So let's take about 111 divided by your 54 cents of EPS per share. That's a PE ratio of 205 for 2024. Yes, the company's growing. That's why we take their PEG ratio, right? So let's divide this by your EPS growth by 40, gives a PEG ratio of over 5. That is just too pricey for me personally. Even though the company's growing substantially, revenue, EPS growth, you need to put it on a common denominator, and that common denominator, what we use is usually the PEG ratio, which is why I did the PEG ratio for all three companies we did today, showing you that Uber is a very decent deal with its growth rate. But even though these companies have higher EPS growth, higher revenue growth rate than Uber, it's just too high for the current share price and the EPS that they're delivering. That is why this company is expensive in my opinion, and just too much shareholder compensation. My favorite cybersecurity play still remains Fortinet. So with all that being said, guys, that was your earnings recaps for the day. I hope you enjoyed them. Now let's get right into your technical analysis of your major indexes. So what's happening with SPY, guys? Very simple, just grinding higher, so not much has changed. We'll go through these quickly. So daily uptrend simply continues right now. Respecting your 12 EMA, first line of defense is going to be the 12 EMA. Any pullback at this point, just for a higher low above 483.03. If you want to see these markets topping out over the next couple of weeks, guys, need to eventually see the bears capture the daily downtrend, and that will start with a loss of your 12 EMA on the 4-hour, and most notably, the first signs of it would be a loss of your hourly trend. Now, SPY has very rarely lost the hourly trend in the past 2 weeks, but that's why when they do lose it, that's when they're trying to set the daily higher low. If we do come down here shortly, you need to measure the size of the pullback. If you pull back too much into your most recent higher low, that could set up for the daily downtrend. That will be the telltale sign that the markets may be rolling over for extended consolidation. That's what I will be looking for to open a short position personally. But as of now, bulls still in full control. It's up to the bears to show us something. QQQ, same concept, right? Daily uptrend underway. Hourly uptrend still maintained by the bulls at this point. So if you do want to see daily consolidation starting, well, that needs to start on the hourly time frame. You need to see a loss of the hourly trend to the bears at this point, and then you will have your daily move lower, daily consolidation starting. At that point, anything above 417 on QQQ, just looking for a daily higher low for potential daily trend continuation. But take back too much of your most recent move, you could then set up for the daily downtrend into weekly consolidation for end of February, early March. So I'll be looking for those two signals on SPY and QQQ over the next course of the next about week and a half of trading, because that, in my opinion, is when it's going to most likely happen. But telltale signs, guys, is going to be most notably the loss of your hourly time frame first, and then watch the size of the move down, retracement size, and that's when I'll be opening the short, trying to make a short here. Stop losses are going to be above your highs, and we are going for the weekly pullback for extended consolidation. At that point, we'll see how the levels do. Now, moving on to XLF Financials. XLF Financials performing well, right? Remaining fairly flat on the day, down 0.3%, but still within yesterday's trading candle. So still in a very tight range here at the top end of the move. That's what you like to see. Daily is still not overbought currently. We have a very nice area, guys, down here, 38 down to about 37.50. If for ever which reason we lose this tightening range here at the top, very nice location here to potentially bottom out our daily downtrend. 38 down to 37.50. That would be very good. But if your bulls just continue setting new highs at that point, daily uptrend just continues, and your weekly leg higher just continues as well. Weekly is ever so slightly overbought. So if end of February we do get a bit of consolidation, I am expecting just a weekly higher low for further trend continuation here into April and May, when the rates are going to decrease. That should be very good for financials. But as of now, no red flags. Keep an eye, 12 EMA, guys. This yellow line, see how well the bulls have defended this yellow line this entire time since November. So if we lose that, it's going to be notable for us. That would usually signify weekly consolidation. The same thing when it happened back here, guys. That was pretty much the end of your weekly consolidation, right? So we're going to keep a very close eye on this as a signal. Now, moving on to XLV Healthcare. Healthcare moving nicely, still above your previous all-time highs, right? So about 144.12, previous all-time highs in your high 142, 143 level. So decent amount of space created now. Daily uptrend is well in motion right now. As soon as we lose the hourly trend, right? If we set a higher low, lower low tomorrow, hourly trend loss, that will be daily consolidation. At that point, anything above 137.21, just looking for a daily higher low for further uptrend continuation. Keep an eye on this level, guys. Previous resistance should be newfound horizontal support. You do have your 12 EMA right there, and this is also the previous area of your previous all-time highs, so should be acting as a decent area of confluence, this whole 142 zone, for a little bit of a pullback for healthcare. As of now, no red flags whatsoever, bulls with tons of space to set that daily higher low. Now moving on to IWM Russell. IWM Russell putting in a 1.52% dig to the upside, which is substantial considering the fact that yields actually had an uptick on the long-term yields today. So IWM Russell kind of defying the correlation for the day, but not out of the woods yet. We need to measure the size of the bounce, right? So they had the daily uptrend, lost the daily uptrend, and now at this point, guys, to reset the daily uptrend, we were looking at the size of the bounce in relation to this move right here. Now, in terms of the size of the bounce, it's looking very good. Bulls now up about 61% of the move, so trying to set up enough space to create space to set the daily higher low for daily trend change. But keep in mind, if we do have February and March seasonality, this could have a very good chance of just setting a lower high into lower low continuation. And at that point, guys, it'll just pretty much be weekly downtrend as well, and just monthly consolidation, extended monthly consolidation. My sweet spot for IWM Russell is between 186 and 180 at this point. I would be very surprised, considering seasonality, considering the amount of rallies we've had over the past couple of weeks through earnings. I'd be very surprised if IWM Russell is able to break and close above here and maintain those gains during consolidation. It's a very big area, right? 201 down to about 195, a very big area of consolidation. We may be coming into some times where a lot of selling and rebalancing is going to happen in the markets. I would be highly surprised if the bulls are able to do it. Can they still do it? Of course, but I just would be highly surprised. I am personally just targeting a potential lower high and maybe just lower low conversions down here, right, into my sweet spot, which is going to provide me an opportunity for buying. But if we, for some which reason, guys, break above here and really set a new weekly uptrend, that will be a break of 199.24, set a new weekly uptrend leading into the next few weeks. Well, perfect. At that point, I'll need to see the bulls really mount above this area of resistance and sit on it, use it as support to really build my confidence, guys, that we're once and for all through this zone and moving on to higher levels for the course of 2024. But I personally believe that that will only happen once we really get an official rate decrease headline. Now, moving on to the Dow Jones. Dow Jones performing very well today, just continuing the gains, 0.13% to the upside. Dow Jones really just on a solid move north, right? Look at the defense of this 12 EMA. It's been doing it the whole time. This yellow line has been a very good line of defense for the Dow Jones. Now, Dow Jones pulling off another daily higher low at this point for further trend expansion. So at this point, guys, any pullback, we'll just be looking for a daily higher low above 38,174. Very healthy, guys, even on the weekly, right? Weekly looking very good too. Nothing to say there. Weekly currently in its second leg of expansion to the upside, right? And daily bulls just in full control, guys. If you want to see the Dow Jones roll over, watch for the hourly trend change as well. Only then will you get daily consolidation. And at this point, the Dow Jones, the notable break for me will be a break and loss of the 12 EMA. And if we set a daily downtrend leading into that, that's just weekly consolidation at this point. Anything pretty much above 37,125. Just looking for a weekly higher low for further trend continuation into 2024. I think the Dow Jones is poised to have a very good 2024, mostly because last year it was kept largely flat while you did have outsized gains in tech. So there may be a very good rotation-based trade coming back into more value-based names for 2024. I would not be surprised. As of now, bulls just remain in full control. Now let's move on to our tech names, right? So Apple pulling back a little bit. So it does seem that Apple's bounce is currently paused for the moment, as the bears have now set the hourly downtrend into today's trading. So hourly downtrend means that your daily bounce is finished at this point. And now we'll be looking, have the bulls created enough space off the lows to be able to maybe set the daily higher low for further trend expansion? Well, yes, they have. They've hit the 618 level. This was the 190 we were looking at. So based off the size of the move, the bulls have now put in enough move to create the space for a daily higher low. So now we will watch, right? Now we will watch how deep does the retracement go. If we come down all the way to about 185, 186 before reversing that hourly trend change, right? Come down to 185, 186, and then get a nice hourly trend change and start another daily bounce. We'll be looking for the daily trend change on Apple. That could be very, very notable to us, right? And that's in the best case scenario for the stock, obviously. Now, looking at a weekly basis, we're still trapped in this weekly tightening range pretty much, right? And if we do get some weakness in terms of seasonality and Apple just unfortunately gives up these gains and trends lower, I am a buyer of Apple stock 180 down to 175. I do think that's going to be the area of consolidation. If the entire market starts consolidation, I do think Apple is going to bottom in this range right here, which would also be just the bottom end of a monthly tightening cycle for Apple, similar to something that they did over here, right? Tightening up at the top end of a move, tightening up at the top end of a move right here. So that is what I'm looking at for Apple. Everything looking decent, but still kind of trapped in range-bound trading right now. Now moving on to AMD. AMD pulling back slightly on the day, and AMD, I'll remind you, we are still watching out for the potential daily downtrend. That would be a break of 162.80. So lower high. If we do get the lower low, that means that weekly consolidation is just continuously underway at this point. The weekly support levels, 164 pretty much all the way to 158 is going to be the area to watch. It's your previous all-time highs. At this point, anything above 134.51, just looking for a weekly higher low for potential further trend continuation. But if we take back too much of this move, may end up in a bit of a tightening range as AMD grows into its current valuation. Once again, I'll reiterate, I was not that much a fan of their earnings. I'm a big fan of the stock. I just figure that they've run a lot more than their valuation entails at this point, leading into this most recent month. So that's pretty much everything for AMD. Just keep an eye on your daily downtrend, and obviously best case scenarios is for the bulls to just tighten this up and then eventually set the daily uptrend back to them. But as of now, short-term bears are in control as we continue this sideways weekly consolidation now for week number 3 at this point. Now moving on to Amazon. Amazon still consolidating sideways after their very nice earnings move. Amazon currently dealing with resistance, right? So your 166 to about 170 has been resistance in the past and is currently acting as resistance on Amazon, but doing a good job here. Daily uptrend is set. This is a daily bull flag, guys, right? Really nice consolidation at the top end of a move. Looks exactly like Netflix. I do expect Amazon to eventually just set the daily higher low at this point on to a new daily uptrend. Hourly looking very good as well. The bulls defending your earnings move very nicely indeed. On the weekly, everything looks great as well. Weekly uptrend confirmed for Amazon right now. So for ever which reason, over the next couple of weeks, we hit a bit of cyclicality and seasonality, and we start trending down, maybe a little daily downtrend on Amazon. That's fine. So much space. Anything above 145, just looking for a weekly higher low at this point. Monthly is also looking very gorgeous for expansion. I do believe Amazon is poised to break all-time highs over the course of 2024. Would not be surprised. As of now, bulls in full short-term control. If we do dip, guys, I will be looking to play some more options on Amazon in the mid to 160 level. So 155, 160 is the area I'm looking for. Now moving on to Google. Google up nicely today, 0.37%, still trying to measure the size of this bounce similar to Apple. So daily uptrend was lost after they flushed the most recent lows. So now for the bulls to regain full short-term control, need to measure the size of the bounce, and you'll see the size of the bounce is about 50%. Needs to be a bit higher to really give us some better probabilities here, but a 50% bounce is acceptable on Google. It does create some decent space for the bulls to be able to reset a daily uptrend here in the form of just daily higher low and now higher high. That would be a reset. And the reason that that's likely possible is just because your bulls control the higher term timeframes. So when you're in control of the weekly and monthly, guys, usually on these moves, on the pullback, you do tend to get some buy the dip activity and reset the daily uptrend just because your longer bulls are in full control at this point. On the weekly, looking very good, just setting the weekly higher low after earnings last week. Keep in mind, Google, for ever which reason, if we do start revisiting some of these lower areas in the process of finding a higher low for higher high, I will be looking to play Google anywhere between 141 to 138 is my real juicy sweet spot for Google per se. So I'll be looking to pick up a few more shares and play some options if we do get down there below. But everything looking very good on Google. Now moving on to Meta, guys. Meta at $470 today, up 0.09%. Not that much, but Meta doing a good job here of holding on to its after earnings gains. You can see a very nice consolidation after earnings here, right? So what we're expecting is we're still trying to set the daily higher low. As of now, it is still a daily bull flag at this point. Beautiful daily uptrend. Just looking for the daily higher low. Anything above pretty much 386.57 is just looking for that daily higher low. Now, the trend has been established back to the bulls at this point, right? So we had an hourly downtrend, which was daily consolidation, and now the bulls have shifted back. However, it is so soon after earnings, guys, that we still could just end up consolidating a little bit more, right? If seasonality goes negative next week, let's say, and we do get a flush of these lows right here, 453.27, it would be a daily downtrend for Meta, and it would be weekly consolidation underway. Anything above 340, pretty much 341, just gonna be looking for a weekly higher low for further trend continuation. I do think Meta is just going to continue rocketing up over the course of this year as they've recaptured profitability and high amounts of free cash flow, but may just be due for a little bit more consolidation. Meta still overbought even after this consolidation on the daily, and weekly also very overbought levels. So may just be time for some pullback. Next area, psychological resistance, going to be your $500 mark. Now moving on to Microsoft. Microsoft performing flat on the day here today after their very nice 2% day yesterday. So Microsoft looking very clean, guys. Just a beautiful daily uptrend at this point, right? So consolidation, right? Equilibrium pattern, basically a tightening range at the top end of a daily move, is very, very, very bullish. Now we had the bullish break yesterday, so new daily uptrend is currently in motion for Microsoft. The upside targets at this point for Microsoft, guys, has to be psychological numbers, right? So can be your 10s, 420, 430, 440, 450, but the bigger one is going to be $450 psychological resistance at this point. Bulls in full control of the weekly after this tightening weekly range at the top end of the move. That's why I love to see tightening ranges at the top end of the move, because usually they do break bullish, especially when your monthly bulls are in full control too. So on the weekly, full control. If for every which reason we do get an extended pullback here leading into the next couple of weeks, I will be looking to play Microsoft as we get closer to this 12 EMA right here. Anything under 400, guys, 387, 385, I might be looking to make a play on Microsoft. Just going to be looking for a weekly higher low for further trend continuation. So everything looking very good on Microsoft. No red flags. Keep an eye on your 12 EMA. That stands for a lot of these names and a lot of your indexes as well. Now moving on to Netflix. So Netflix still continuing the daily downtrend. This is what I'm kind of expecting from Meta. If we fail right here and set the lower low, it'll just like Netflix, right? Very slight daily downtrend, but in the grand scheme of the size of the move, it's very, very healthy daily bull flag at that point. So Netflix pretty much daily bull flag at this point, daily downtrend, but looking extremely good on the weekly, right? So weekly uptrend still in motion. As you have a daily downtrend now, we're just looking for weekly consolidation, anything above 462 just for weekly consolidation. And this is really coming off the levels from 2020, 2021. Big range, and the top end of that range was about 575. That was the area that Netflix has been struggling with currently, not able to break it just yet. So short-term bears are in control, yes, but we're doing a good job of cooling off your after earnings move. The daily RSI is now back below overbought conditions. Your 12 EMA is right there as support. So it may just be a case of daily bull flag, right? Slow movement, weekly consolidation, and then ready to move later on, potentially in March here. Because I do think, guys, that now that most of big tech has reported earnings, a lot of your other companies have reported earnings, there's going to be a bit of a lull in the market, right? Everything is kind of a bit rich now in terms of how high everything has moved. So it may just be some time for some consolidation, but I do believe in Netflix. Maybe after a bit of consolidation here down into the lower $520 area is where I would personally be interested in making some plays. Now moving on to NVIDIA. NVIDIA up again here today, cracking through the $700 level again, but pulling back ever so slightly. But NVIDIA, guys, nothing much to say. This is just a very healthy daily uptrend. Very extended on the daily RSI, very extended on your weekly RSI, but it's NVIDIA. It's been like that pretty much for a better portion of last year. You can see how many times the daily has been in overbought conditions and can stay in overbought conditions, and couple that with the weekly as well. Weekly was able to stay in overbought conditions, guys, from March all the way through August. So keep that in mind, guys. NVIDIA is no stranger to overbought conditions. So going off that alone to determine a market top will not be enough. There's a lot of hype behind this stock. Just need to go with the higher high and higher low patterns at this point, right? So higher lows, 606.92. Any drop above 606.92, just looking for a daily higher low and then daily trend recapture or just daily trend resumption by the bulls right here. But if for whatever reason we pull back too much, it opens the door for a daily downtrend, and only then will you have a bit more weekly consolidation on NVIDIA. Keep in mind, guys, NVIDIA does have earnings in about 2 weeks now, right? In 2 Wednesdays from now, we have NVIDIA earnings, so we'll be very curious to see how they react on earnings. Has a lot of the earnings move already been baked into the stock price over the past 4 or 5 weeks, or after earnings, will they continue to just mount the levels at this point? That is what's remaining to be seen. I'm personally not making a play on NVIDIA before earnings unless we come considerably lower here. I'm talking below $600. Only then would I consider making a play on NVIDIA before earnings. Now moving on to Tesla. So Tesla doing a good job here, guys, up 1%, and now the bounce is getting significant. So daily downtrend, right, into our most recent lows here of about 175. Now we measure the size of the bounce. So now that bulls have recaptured your hourly trend to them, as we've been saying, need an hourly trend change. We've been in an hourly uptrend now. The size of the bounce is crucial in relation to your most recent lower high, which is right here at about 196, right? So let's take a look at the size of the bounce. Now you'll see the size of the bounce today got up to about 80%. So that gives the bulls the best case probabilities to be able to set, once this move tops out, a daily higher low for a daily trend change. This would be the first daily uptrend, if they can do this, first daily uptrend since pretty much the beginning of the year. RSI now back into normal conditions after being overbought for quite some time. Yesterday, we pointed out the negative divergence or the positive divergence on the channel as a whole. So you can see here, lower lows on the price, higher lows on the RSI. That is known as positive divergence, and usually price does correct in the direction of the divergence. So very nice to see that playing out. You also have your daily MACD about to be crossing. So a lot of good momentum signals that Tesla still has a little bit of room to the upside to potentially move. So if they're able to mount 196, then we may be setting up for a potential daily uptrend reversal to the bulls. And then we'll be watching how much of this weekly move can we recapture. The bulls have a very long way to go before putting in the necessary steps to reverse this into a weekly uptrend, because your bears control the weekly downtrend at this point, right? They control the monthly downtrend as well. So now we're just kind of trying to go counter trend and set up the daily to start reversing some of those larger term timeframes. But I like Tesla in these lower levels. As long as it stays down here, I will continue to play options on it, as I have been doing in the past couple of weeks at this point. 180 to 170 is area of horizontal support for your confluence and the lower end of this downtrending channel as well. So close as possible, the 175, 170 I can get, I will continue to play those options. Now moving on to Palantir. Palantir, another almost 4% day on the day here today, and you can see your hourly bulls are still in control. So as long as we don't lose this hourly time frame, your daily move simply just continues higher. Now, fairly overbought on the daily RSI, but you can see here Palantir has been no stranger to being overbought on the daily RSI, so this move can continue. Overhead resistance, guys, we're now in the resistance zone. This is everybody who was trapped in 2021 before the massive 2022 sell-off. So this area stands to argue should be a decent area where a lot of people would be looking to either exit their shares that they've been at a loss in for the past 2 years, maybe even break in, or a lot of people who bought in at $7, $8 may be taking profit up here after such a substantial rise. So the top end of this range, guys, $26.50 is your first target, and then $28. So coming up on the midpoint of that right now. So just keep an eye on this area of resistance for Palantir. But as of now, bulls looking amazing, creating so much space, guys, that as soon as we pull back from this move, the likely scenario is just daily higher low, into further trend continuation. And now that we're above your previous area of resistance, the $22 mark that we hit earlier in November, should be a very decent location to basically just be able to sit down on it. It's also coinciding with the bottom end of that same range we were talking about. So 2022 should be a very nice area to come back and sit as support if ever we need to come back down in that area. That also coincides with the next location I'll be playing Palantir. If ever we do revisit the $22, $21 range, that's where I'll be looking to potentially play some options for them. And now lastly, PayPal, guys. PayPal very disappointed after earnings. They had a very large move here. 11.2% to the downside. You can see that right here. 11.2% to the downside for PayPal. So really negative day. And unfortunately, a lot of the technicals have now come undone. So now that we lost this tightening range, the bears are maybe looking up to set up for a daily downtrend. This whole area as well, $60 to $57, the area that I said we could not lose, has officially been lost. So this whole area should now unfortunately be acting as resistance. So now at this point, we could expect a scenario like this to where we just get a lower high for potential lower low continuation here, right? On the weekly, it doesn't look much better either. We are now really back into this downtrending channel. So we had a chance of breaking above your downtrending channel for the most part over the past 3-4 weeks at this point, but unable to do it. So this downtrending channel just continues at this point. So our price targets for PayPal, if we really continue this slide, you can see, guys, we lost the daily level right here. Daily downtrend has a good chance of being set up by your bears right here. And if that does happen, unfortunately, we are once again going to be targeting the bottom end of this range. At this point, guys, it's really like $45, which would be fairly low. We do have this horizontal support right here, $50. Now is just a time where it's going to have to be all about investors and Wall Street. Will retail investors And will institutional investors step in and determine this stock is cheap enough for them to buy? Their earnings weren't all that bad yesterday, although they decreased guidance for the year. We went through their earnings, and actually, as a matter of fact, they weren't that bad, guys. It's just they weren't the growth story that people were necessarily saying that they could potentially become into 2024, seemingly that 2024 is once again going to be a transition year for the company. So a bit of negative news there. Palantir for PayPal for me at this point, guys, becomes a buy as close as possible to $50. I'm not going to be trying to buy this falling knife right here. So we're really going to let the earnings process bottom out. Try to see if we're using this area as resistance. If we do set the daily downtrend at that point, guys, I will just be waiting patiently for PayPal. Really want to start clipping the bottom end of this. So we'll be looking, can we get oversold conditions on the RSI? We will see, guys, but now kind of an in-between zone for the stock. If we recover nicely tomorrow, back into this area and able to close above into $60, that's a different story. But for now, not expecting that. Expecting there, most likely, guys, to set up for a daily downtrend before we really get into a bottoming out process. So unfortunate loss there by PayPal shareholders, but still very bullish on the company for the long term. And that is pretty much everything that I had for you guys today. So if you enjoyed the video, consider dropping a like. Tomorrow, we're going to be doing the weekend portfolio recap, see how we did over the course of the week. So as usual, guys, if you enjoyed the video, consider dropping a like. Really helps me out for the algorithm, and consider subscribing to the channel if you're new. We do these videos Monday to Friday, recapping major technical indexes, major technicals on your indexes, your major tech names, and also we do some earnings plays too. And as usual, guys, if you have any questions whatsoever, feel free to leave them down below in the comments, and I'll get back to you within the first 24 hours. See you guys tomorrow after the close. Peace.